name's Rory Stokes. I'm one of the fund managers in the European Smaller Companies Trust. And I'm here today to tell you why you should not overlook Europe and its small cap stocks. But, you say, the only game in town is the Magnificent Seven. US mega-cap tech, AI, growth, American exceptionalism. Well, I ask you, who knows how many of the Magnificent Seven are alive at the end of the film? Okay. Any guesses? Two, three. It's three. Steve McQueen and Yul Brynner being two of them. It's maybe not as safe as it seems. So, why Europe? No doubt you've heard all of the reasons or problems with the space, war in Ukraine, political instability, meddling bureaucrats, Trumpian tariffs. So, why invest in European small cap? Well, the reason to invest in European small cap is because you persistently make money over time being exposed to it. The orange line here shows you the performance of the European small cap benchmark since the turn of the century. And the black line shows you the performance of European large cap. You can see in the bottom table, small cap versus large cap in Europe. A green box means that small cap has outperformed. And you can see that roughly 2 out of every 3 years, small cap outperforms large cap, and typically by quite a large degree. And the eagle-eyed of you will see that in recent years, that has not been true. We've been in an unusual period since the war in Ukraine that has seen large cap outperform small cap. But you see in 2025 that it looks like the tables have begun to turn again. So why do you make money? Well, you make money because despite what you may think about Europe, there is growth. But the growth is in small cap. So the orange bars here are showing you the number of years that the EBITDA growth, so effectively the cash profit of a company, is bigger for smaller companies than larger companies. Fully 3 out of every 4 years, you will see more growth out of small cap in Europe than you will out of large cap. And you'll get that with very conservative balance sheets. The amount of debt on the companies for small cap is only 1.4 times an average, so about 1.5 times their profitability they have in debt. And fully 1 in 3 companies in my universe has got net cash on the balance sheet. And it's where the action is. 90% of all the M&A that happens in Europe since 2008 has been under 5 billion sterling market cap. And that's where you're capturing big premiums for the companies that you've invested in. That is a reward that's just not available if you're looking at large cap companies. And small cap does well when things are going well. And since 2022, that has not really been the case. The black line here shows you European small cap versus MSCI World, and you can see it's not been a particularly fun time to be a European small cap fund manager the last few years. The orange line shows you the Purchasing Managers Index in the Eurozone. So how optimistic are the economic decision makers in Europe? And you can see that it fell off sharply following the Russian invasion of Ukraine. But actually, in the last 18 months has been stable to even beginning to recover. And my market is extremely cheap. It's cheap, really, as it has been in the 25 years that I've been looking at smaller companies in Europe. Typically, the chart here shows you the premium or discount of European small cap versus large cap in the top panel and against US large cap in the bottom panel. So typically, European small cap trades at about a 13% premium to large cap. Why? It's because where the growth is. Currently, we're at an 8% discount. If you compare it to US large cap, to those Magnificent Seven, normally we would be at about a 9 or a 10% discount. Currently, it's a 37% discount. The valuation discrepancies between smaller companies and larger companies in Europe is big, but smaller companies versus large cap US is enormous. And it's a great place to be an active manager. There are about 1,500 stocks in my benchmark. 75% of them have 5 or fewer analysts looking at them. And the dispersion of outcomes is enormous. You can see that in the bottom right-hand panel, that every year, the range of outcomes in small cap versus large cap is very, very big. And it's in stocks that you hopefully haven't heard of. There's a genuine diversification benefit that comes from investing in this market. And there's big, big performance to be found. So a stock like Renk, for instance, which makes the gearboxes that go in tanks. Well, they've had a good couple of years. AIC Group. AIC Group make creatine. So those of you that are into your sort of getting jacked in the gym, that's creatine is the product you want to take, and AIC are the only Western producer, the purest form of that supplement in the world. But they also make a product called nitroguanidine. Nitroguanidine is a propellant that goes into car airbags. So if someone crashes into you and your airbag goes off, the nitroguanidine will have been what set it off. It is also one of 3 standard ingredients in NATO 155mm munitions. They're the only supplier in the West of it. Again, a company that's had a good couple of years. Greek banks. Greece is a basket case, right? We all know Greece is a basket case. Wrong. Greece has been the highest performing economy in Europe for 2.5 years now, and the banking sector is now largely, completely reprivatized. There's only 4 players left. Alpha Bank is one of them, and it's done very, very well this year. A lot of the prejudices we carry about Europe are really not quite as they seem. So why now? The world is a dangerous place. We see that from stocks like Renk and AIC and how they've been doing. And Europe often looks like a bit player when it comes to that dynamic. It's all about Asian growth or American exceptionalism, and Europe's caught in the middle. But it's not priced to be an exceptional place. It's a very, very cheap market. And change is coming. With the advent of or the death knell of the debt brake in Germany and the fiscal expansion that's coming, there is a big, big economy in Europe that's got a big balance sheet capacity to do a real fiscal stimulus. And it's combining that with reforms. Now, Germany, often people think Germany is basically a scaled-up Switzerland. It's not. Germany is as much of a basket case as the UK is, but has the capacity to do something about it. There's huge funds coming to spend on infrastructure, on defense. All that is coming through. All of that is going to drive the economy next year. And we're coming from a fallow period of consumer confidence. The black line here shows you consumer confidence in the Eurozone. The orange line shows you real wage growth. We've actually had a couple of years of real wage growth in Europe, but because of the politics worries, because of the digestion of the energy shock, it's not really turned into economic activity yet. But I've been to Germany twice in the last 6 weeks, and there is a real change in sentiment happening there. There is a real optimism for next year, and as that fiscal stimulus comes through, that consumer confidence is latent to really drive things forward. And in European smaller companies, you can be directly exposed to things getting better through names like Westwing, which is an online furnishing company, or Bike24, which is the last man standing when it comes to online bicycle and bicycle apparel retail in Europe following the post-COVID bicycle crash that has occurred. Now, I need to have some compulsory slides in here, which I've put in, but I'll use these to illustrate a couple of things. One, I wanted to show you that there is tech in Europe, there is growth, there is really interesting things to be exposed to. So about 16% of this portfolio is directly invested in European tech companies. They're almost always doing part of the supply chain that makes the global tech companies work. And we're also pro-cyclically struck with our industrials exposure. And some boring metrics, but we're cheap, 13 times PE versus the benchmark on 13 times. And the underlying portfolio yields 2.9%, which I think gives me a nice segue into a bit of corporate activity that's been happening with this investment trust, because we will be combining with the European Assets Trust in the coming days. And as a result of that combination, we will be moving to paying a 5% dividend yield. This has led to a lot of people worrying that we're no longer pursuing capital growth. And I just wanted to reassure you that that's not the case. We will continue to pursue the capital growth that we have over the last 14 years that Ollie and I have been running this trust. But we have large revenue reserves, and we will be paying the incremental dividend out of those revenue reserves for a number of years to come. And then finally, the performance. So whilst it's been a challenging period to be a European fund manager, there's still actually a lot of return to be found in this space. And we feel very optimistic that with cheap valuations, low sentiment, the opportunity to really drive performance, drive value for our investors is there. So that's my pitch to you as to why Europe, which basically boils down to it's been rubbish, but it's going to get better, and it's not priced to do that. Thank you very much, and I'm available for questions should you have any.
Thank you very much, Rory. Thank you for that presentation. I'm pleased to say that I have, as of Wednesday, I think, become a shareholder in ESCT.
Wonderful.
And this is obviously a big change for your trust. What effect will it have on your investing activity? What changes will you be making to the new situation?
The investment process is not going to change at all. There has been a degree of administrative burden that has been placed on the team over the last few months to get this organised, and that, thankfully, will be coming to an end in the next 2 weeks. The shift in the dividend structure that we've brought in from European assets is a bit of a change, but that's not something that will really bother the managers too much. That will be done by the wider team. So it will be more of the same, but we'll be paying a bigger dividend out of capital. But since we had to fend off Saba Capital, we've changed our structure around discount management, and the dividend approach that European Assets took was actually quite effective at managing discounts. And so we're viewing that as a discount management strategy that's really not that different from doing a share buyback and is perhaps more effective.
There's a question here.
How would you compare the European smaller companies market to the UK smaller companies? And have you adapted the portfolio in light of the threat from China, especially in some sectors?
By how does it compare to the UK? Do you mean in terms of valuation and opportunity? Or? Yeah, so the UK is slightly cheaper. And UK small cap fund managers probably a bit more depressed. It's been a very, very challenging time. There's been big outflows in that space. We don't typically directly invest in the UK in this investment trust. This is a continental European fund, so it's ex-UK. But as part of our broader remit, we do run some pan-European funds. So we do look at UK names. And I mean, I can see that there is a huge opportunity in the UK should we get that inflection in confidence, which I don't sense any real urgency to yet. The good thing about the UK, which you don't see so much in continental Europe, is corporate activity in terms of M&A is a lot easier in the UK. If you put a 25% premium for a company on the table, you will almost certainly get your deal, whereas it's not so guaranteed with some of the less favorable shareholder governance structures that you see in my market. So when the UK goes, it could go quite hard because there are some great businesses that are trading at some really, really silly prices in the UK market.
And what about the threat from China? I think there's a sort of second
yeah,
part of the
that's not a new thing. 25 years ago when I worked at CSFB, all the German small companies were doing solar panels, and they don't do that anymore. The German automotive companies have been complacent around the risk that's coming from China, and the price that you pay for a Chinese EV versus a German one, which is of similar quality now, which wasn't necessarily always the case, means that we are in a far more competitive world. And so we have to make sure that the exposures we have are not to companies that are structurally in very bad places, but actually have opportunity. And Germany has this label of automotive, but actually there's some terrific engineering companies that are nothing to do with automotive that we're doing all sorts of engineering. Alzchem is a great example. Alzchem is the specialty chemical company. No one knows that it exists, but actually it's a crucial part of NATO defense as it currently stands today. There's lots of little businesses like that doing really incredible stuff where China's just not an option. The Americans are not going to be sourcing nitroguanidine from Chinese suppliers. And so, we're alive to it. It's always been a threat. It's probably just more prominent now because it's obvious around the automotive industry, but I don't think it's new news.
I think there was another question at the back there, and then there's one right over in the corner there.
Just around your process and idea generation, are there specific criteria that you look for in your companies and when you're sort of generating fresh ideas, or is it such a varied space that it's impossible to pin specific criteria to it?
We go to great lengths to not be broker-led in terms of what we do. It's entirely about independent idea generation. We use a number of tools to do that. I used to work at a company called Holt Value Associates that got bought by CSFB back in 2001. They've got a screening tool that's now owned by UBS. We use that for screening, benchmarking, valuation. We get data from Nordea that gives us a similar screening tool. We've got data from our colleague Nick Sheridan. And the whole idea is that we're looking for companies where the reality is different from the perception. And I didn't go into it in this slide, but we have this, if you're to look at our portfolio compared to our competitors, we are two things. One, we're typically smaller in terms of the average market cap of the companies we invest in, and we are more value. We're about as value as the benchmark, whereas our competitors on the whole are mid-cap growth. So we have a valuation discipline to what we do, and we invest across the corporate life cycle. So we try and blend the portfolio with 5 to 10% early cycle, rapidly growing companies, typically 40 to 50% high return on capital companies that can compound growth. About a quarter is in boring, mature companies that generate cash and give it back to us and are mispriced. And about a quarter is in self-help turnaround stories. And the whole philosophy is about finding management teams that understand value creation. So if you've got a bad business that's not earning its cost of capital, we're looking for a management team that are prepared to take tough actions, fire people, improve margins, sell things. If we've got a great return on capital company. We're looking for a management team that know how to grow it. And so that value creation and the price that we pay for these companies, we're valuing the whole company and what is it really worth, and then thinking about, what does our portion of that come down to? And by blending that all together, we end up with a portfolio that's about as valued as the benchmark. But philosophically, those are the key points. We're not value managers, but we're valuation aware in terms of what we do.
Okay. Next one was over there, and then there's one over in the corner there.
Just a quick question about families in Europe and in this space. How do you interact with families? How do you view family ownership, opportunities and threats around that?
Yeah. So in Europe, it's quite often typical to have a company that has maybe 30% of the company owned by a family, but effectively controlled by it. And it's either good or bad.
That's helpful.
Where you've got a family that understand, or for instance, if it's still the entrepreneur himself or herself that's there, they're aligned, they're passionate, we're aligned. If you're having to navigate second or third generations, it really boils down to how much they're interfering in the business and how much they all hate each other. And that's a bit harder to find. And CEOs aren't always that open about sort of the family politics. We have to sort of gently poke around to see sort of whether the people behind the people that we see get it and want the capital growth.
There was a question in the back corner here.
Thank you for an excellent presentation. It was very convincing. We've had comment from certain bankers this week, I think, about a bubble in North America bursting. Now, I don't know what a good comparison to that is, but say in 2008, when America had problems, that impacted on smaller companies in Europe quite significantly. And I wonder just how you're protecting against that, because as a private investor, obviously well diversified, and this would be just one investment, the timing would seem to be really important when you invest in what may be a high-risk environment at the moment.
So clearly I'm alive to the concentration risk around mega cap tech in the US. And what's interesting is that the Magnificent Seven today doesn't include Tesla. It's now got Broadcom in it. So we've already seen one of the Magnificent Seven get shot. There's really only six of them left. Yeah, exactly. So, is it on my mind? Yes. I think the problem is that bubbles are very easy to identify in retrospect, and the consequences of them will depend slightly on the transmission mechanisms that work through. 2008 was, hopefully unique in the transmission mechanism was through the banking sector being too leveraged and opaque valuations around opaque assets. That's less obviously the case today, though private equity and private credit are areas where we can't really see what's going on as spectators here. The ideal scenario for me would be that we see a broadening of the market, and I think it's intuitive that we will. I think what's interesting about the mega cap tech is that there's still no revenue model around AI. And much like in 2000, which I think, 98 to 2001, I think is a more appropriate analogous period where we saw huge amounts of capex going on with no one quite knowing how they were going to get a return on it, but assuming that the benefits were going to go to the telecom companies. Actually, what happened was the telecom companies went back to being perceived as utilities, and the benefits were to the broader society. And I think AI is going to be a lot like that, where if you're mega cap tech, you have to spend this capex to stay in the game. But actually, you don't know how you're going to earn any money on it. And actually, the beneficiaries will be smaller companies, the consumer. If it goes crazy, and you tell me where we are in that cycle, it would there could be a way to go, or there might not be. But
But I think if I was to paraphrase the gentleman's question, it was sort of, if that does burst,
yeah.
then what's the knock-on impact of that?
Well, there will be a real-world
Small
impact
companies?
if we have a spectacular bust. There will be a wealth shock in the US, and the idea that that won't be contained as slowing GDP elsewhere, I think, is fanciful. There would be some bumpy quarters. I say 1/3 of the companies in my universe are net cash. We do not have stretched balance sheets in the companies we're invested in, and we try and monitor the cyclicality sensibly as best we can. But yeah, so long-winded answer to your question. Apologies.
So the negative downside is amplified by a lack of liquidity because it's smaller cap.
You get you double effect. Yeah, you have both the cyclicality and the liquidity effect. But you're not starting from elevated multiples in small cap as it currently stands. And we take liquidity very, very seriously. We run open-ended vehicles as well as the permanent capital vehicles. Our internal rule of thumb is that we have to be able to liquidate the entire portfolio, 80% of it within 1 month, and we're in the mid to high 90s at the moment. We run a long list, and one of the reasons we run a long list is A, we make a lot of mistakes and we want to be able to get out of them, and B, liquidity isn't there when you need it, and so belts and braces make sense.
We're nearly out of time, Rory. I had one last question which is coming online, which is when you're making your portfolio selections, you had a slide that touched on this a little bit earlier. To what extent, you're obviously trying to pick great companies to invest in, but to what extent are you looking at asset allocation across different sectors as well? So how much you've got exposed to tech or to automotive or whatever it happens to be. Do you take that into consideration as well, or is it just great companies first and the sector allocation is almost a byproduct?
If you look at the attribution analysis over the last 10 years, almost all the performance of this fund is due to stock selection. We are aware of how we are positioned from a sector perspective, but we're not sort of moving money from one sector to another. It all comes from bottom-up stock picking, and then the sector selection is almost like an output. But if it looks like it's concentrating a risk that we're unhappy with, then we would take that into account.